Title: Is Nvidia the source of alpha or a crowded trade on the brink? Is Nvidia still the ultimate source of alpha, or has it become a dangerously crowded risk exposure? While retail investors across the globe are glued to GPU shipment data, scrambling to chase the tape, Wall Street's top funds are executing a very different playbook: distribution. Please understand, this isn't just a simple technical pullback. This is a fundamental pivot in liquidity. In the dark pools, those private exchanges where the trades you don't see happen, institutional money is decisively rotating out of the pure hardware sector. And who are they offloading these positions to? To the lagging investors betting on yesterday's trends, hoping for linear growth to continue forever, essentially? The people staring at their screens right now? If you are feeling anxious about missing the Nvidia boat, you are focusing on the wrong horizon. The trading logic of 2025 is already playing its final notes. In the eyes of institutional investors, the macro script for 2026 has already begun. The so-called smart money is currently flooding into a completely new territory that the masses are ignoring. My goal today isn't to just toss out a few speculative tickers. We need to decode the asset allocation strategies currently being debated in top investment bank boardrooms. I'm not just going to tell you what to buy, but the underlying logic of why. We are going to explore the 3 structural opportunities that will pick up the baton from the Magnificent Seven and offer the potential for exponential returns over the next 5 years. These sectors are sitting right at the inflection point of the S-curve, just like Amazon in 2010 or Apple in 2003. To see the path forward, we must revisit the dot-com burst of 2000. Back then, if you walked down Sand Hill Road or stood on the floor of the NYSE, everyone was fixated on one core question: who will dominate the internet age? The consensus was shockingly unanimous. It wasn't Amazon, which was losing money selling books, and it wasn't the startup Google. It was Cisco Systems. In that cycle, the valuation logic for Cisco was identical to the bull case for Nvidia today, perhaps even stronger. The fundamentals were simple and seemingly bulletproof. The internet is inevitable. Every company must digitize. Therefore, they must buy Cisco routers. It doesn't matter which website wins, the infrastructure provider always collects the toll. Driven by this consensus, Cisco briefly became the most valuable company in the world, surpassing Microsoft. However, the capital markets revealed their brutal side. If you bought Cisco at its valuation peak in March 2000, even though it was a company with excellent fundamentals, do you know how long it took to recover your principal? 20 years. Why? It wasn't because the internet disappeared. It was because infrastructure has a physical ceiling. Once the fiber optics are laid and the routers are installed, exponential hardware growth hits the wall of diminishing marginal return. When everyone already owns a shovel, selling shovels stops being a high-margin business. But, and this is the most critical insight for today, value creation didn't stop in 2000. Quite the opposite. While Cisco's stock stagnated and retail investors left in despair, the true alpha was born. Amazon used that low-cost network to rewire the global supply chain. Facebook used the excess bandwidth to connect 3 billion users. Netflix used high-speed fiber to disrupt media distribution. We call these the application layer giants. They only unleashed their massive commercial value after the infrastructure matured, after the highway was open, creating thousands of times the return on investment. Right now, the market cycle is showing a fractal similarity to that era. Let's re-examine the AI sector. Look back at the last 24 months. Microsoft, Meta, Google, Amazon. These hyperscalers have poured tens of billions into capital expenditure, porting GPUs and building data centers. This is the fastest, largest infrastructure build-out in modern financial history. But just like the fiber boom, as the grid matures, we are starting to see structural, localized oversupply in compute power. Now, the patience of fund managers controlling hundreds of billions of dollars is running thin. On quarterly earnings calls, they no longer care how much hardware Mark Zuckerberg is buying. And they aren't impressed by simple AI demos anymore. They are pressuring management with the ultimate question. Show me the money. You spent $50 billion on capital expenditure. When will we see the return on investment ROI? When does this compute power turn into net profit on the balance sheet? This valuation pressure from the capital markets is forcing the tech industry into a violent strategic pivot, switching from a growth at all costs infrastructure phase to a profit-oriented application phase. Therefore, My fundamental thesis is that 2026 will be defined as year one of AI application. In this cycle, we stop going long on the hardware merchants selling the shovels and start hunting for the companies using those tools to dig up high-value assets. So, where are these assets hidden? Through quantitative screening of massive amounts of research, I have locked onto 3 sectors at their explosion point. Opportunity has shown service as software, vertical B, 2B. The first opportunity is hidden in the seemingly boring world of B2B enterprise services. It lacks the media hype of consumer products, but it has the deepest moats. You are familiar with SaaS, software as a service, like Salesforce or Adobe, but on Wall Street, we are pricing in a new paradigm, service as software. Note the difference. This isn't just wordplay. It's a collapse of the business model. In the traditional SaaS era, customers bought software to improve efficiency. You bought tax software to help your accountant work faster. The business model was a monthly subscription fee. But in the future, in the age of AI agents, clients won't buy software to improve efficiency. They will buy it to replace labor. We are looking for companies with vertical data gravity. Take the legal industry. We know GPT-4 is powerful, but it has a fatal flaw. It cannot access the tens of thousands of private contracts your firm has written over the last decade, nor does it understand the unwritten customs of your specific industry. However, there is a class of legal tech companies taking a general model and fine-tuning it with massive amounts of proprietary, annotated case law data to create a super AI lawyer. What problem does this AI agent solve? It can instantly review hundreds of pages of complex M&A agreements, spot risk clauses, and draft revisions to send to opposing counsel. At this point, the company isn't selling a tool, it is delivering a result. For a law firm or a Fortune 500 legal department, this means they no longer need to pay a $200,000 salary for a junior associate who needs sleep, has emotions, and might quit. They just subscribe to the agent for 1/10 of the cost. This is the source of margin expansion. When a software company starts cutting into the total addressable market of labor costs, its valuation ceiling is shattered. Previously, it was earning IT budget. Now it is earning payroll budget. If you are stock picking, ignore companies building co-pilots to assist humans, and go long on companies brave enough to claim they will replace humans. Focus on legal, medical diagnostics, and financial compliance areas with high data barriers and expensive labor. Opportunity, #2. Embodied AI, the supply chain. The second track sounds like science fiction, but it is driven by cold, hard demographics. This is embodied AI, or humanoid robotics. Why are institutional investors heavily allocating here? Many think it's just Elon Musk's marketing. Wrong. The root cause is the structural collapse of the global labor market. Look at the macro data for the US, Europe, Japan, and China. An aging population is irreversible. Even worse, the willingness of the younger generation to supply labor has structurally shifted. The new generation does not want to work in factories, logistics, or elderly care. The blue-collar labor shortage is systemic. It cannot be solved by raising wages because the supply side is drying up. If LLMs, large language models, solve the marginal cost of brain power, embodied AI will solve the shortage of physical power. Between 2025 and 2026, we will see the iPhone moment for robotics. Why now? Because AI models have finally given robots a brain. Traditional robots like Boston Dynamics had great motor control but zero cognitive ability. They were hard-coded for closed environments. The new generation, powered by vision language models, has a semantic understanding of the physical world. They understand natural language, not just coordinate code. How do you allocate assets here? My advice for individual investors is clear. Avoid the OEMs, the robot makers, and go long the supply chain. Just like in the EV war, whether Tesla or BYD wins the battery supplier, like CATL wins regardless. In robotics, you want the core component suppliers. Look for precision sensor manufacturers. For a robot to avoid obstacles and handle delicate objects, it needs expensive force and vision sensors. Look for companies providing simulation training environments. This is Wall Street's hidden gem. Robots cannot learn in the real world. It's too slow and expensive. They need to run billions of reinforcement learning cycles in a computer-generated virtual world, a process called sim to real. Whoever owns the physics engine of the virtual world owns the operating system of the robot age. Opportunity #3. AI plus biotech. Tech bio. The third track has the highest risk appetite but the most staggering potential. Alpha, AI plus biotech or tech bio. The pharma industry is trapped by Eroom's law, the reverse of Moore's law. Developing a new drug takes 10 years and costs over $1 billion. And the killer? The clinical success rate is less than 10%. In finance, this is a terrible risk-reward ratio. But AI is transforming biology from an experimental science based on trial and error into a data science based on computation. Think of it this way. In the past, to make a key, you couldn't see the lock's internal structure, so you blindly tried 10,000 keys. Now, AI, like AlphaFold, directly analyzes the 3D structure of the protein and generates the matching molecule. Modern AI drug discovery companies can simulate billions of molecular interactions on silicon chips, completing in days what took human scientists years. This efficiency gain isn't linear, it's exponential. If AI can compress the drug development cycle from 5 years to 12 months and cut costs by 90%, what does that mean for giants like Pfizer or Novartis? It means an explosion in profit margins and cures for previously untreatable diseases. We are seeing big pharma aggressively signing deals with AI startups, with single contracts worth billions. The investment logic here is hardcore. We are not looking for companies trying to build sales teams to sell drugs. That's a heavy asset model with high risk. We are looking for companies selling the algorithm platform. They don't take the binary risk of clinical failure. Instead, they provide the algorithms and data to big pharma in exchange for milestone payments and future royalties. It's a high-margin software business model, just wrapped in a biotech coat. This is where the 10-baggers, stocks that return 1,000% of the next 5 years, will be found. Portfolio construction, the barbell strategy. Those are the 3 sectors. Now, the million-dollar question. As a regular investor facing this paradigm shift, how do you build your portfolio? I know, you might be feeling hyped up, ready to sell your Nvidia and go all in on small caps in these sectors. Stop. That is a classic retail mistake and the beginning of capital destruction. The market environment of 2026 is vastly different from 2023. 2023 was a beta market, a rising tide where anything AI-related went up. But next is an alpha market. The market will be cruel and selective. If a company only has AI in its PowerPoint but no real revenue in its financials, it will be ruthlessly dumped next earnings season. I recommend the classic Wall Street barbell strategy to manage risk. One end of the barbell. Allocate 50% to 60% of your capital as a defensive cornerstone. Do not completely dump hardware, but rebalance. Here, I want to highlight an undervalued sector: energy and utilities. AI is fundamentally a game of electricity consumption. Data centers require astronomical amounts of power. Whether OpenAI or Google wins, they both must pay the electric bill. Utility stocks, especially those mastering nuclear and SMR, small modular reactor technology, are the consumer staples of the AI age. They may lack explosive growth, but they have wide moats and stable cash flow to protect your principal during volatility. The other end of the barbell, allocate 30% to 40% for high-odds offense. Distribute this among the 3 directions we discussed: vertical SaaS, robot supply chain, and tech bio. For most non-professionals, I do not recommend picking individual stocks because the technical uncertainty is too high. The optimal strategy is to buy ETFs focused on these subsectors. Or, if you can read financial reports, look for industry leaders who have been digging in their niche for over a decade and check if their AI subscription revenue is showing massive quarter-over-quarter growth. Let me conclude with a macro perspective. Every technological revolution is essentially a violent redistribution of social wealth. In the 19th century, wealth belonged to the railroad tycoons and steel barons. In the 20th century, it flowed to oil giants and automakers. In the early 21st century, it concentrated in the internet platforms that controlled traffic. The next decade of excess wealth will not belong to the makers of compute power, because compute will eventually become a generic utility like electricity. Future wealth will belong to those who do not worship the compute itself, but know how to wield it to solve actual pain points, replace expensive labor, and create entirely new commercial value. I am not here to give you motivational fluff. I am showing you the underlying logic of capital flow. If you want a specific watch list for these three sectors, including specific ETF tickers and fundamental analysis of leading companies, leave a comment below. Like, subscribe, and let's stand together at the peak of the next Kondraty wave. See you next time.